Good afternoon, everybody. Assalamu alaikum wa rahmatullahi wa barakatuh. The title of this session is a little arrogant, I think. I certainly don't pretend to be successful in every captive project that I undertake. I do have some examples of projects that have not quite succeeded. Of course, that was never my fault. That was always somebody else's fault. But if pressed, I'll give some examples of those. I'd also like to invite questions as we go, either through Slido, or if you want to interrupt me and fire a question at me, please do so. I reserve the right to divert the difficult questions to other experts in the room, so just be aware that I might be pushing one over to you at some point. If I don't know the answer to something, I'll be honest and tell you that, and then I'll find out the answer later. So when we're talking about a captive project, I'm talking about either a new project, a review of whether a captive can add value to the parent organisation or not, and about reviews of the strategy of existing captives. So looking at those two key areas: feasibility of initial captive establishment and review of the strategy of existing captives. So how do we define what is success in a captive? I think firstly, we could look just briefly at the key values or areas of value that a captive can provide to the parent organisation. And I think it's important that we phrase or frame the value of a captive in terms of its ability to contribute to the parent achieving its own objectives. Captives are not formed in order for the parent company to generate profit from insurance activity. That would be a commercial insurance company. Captives are formed in order for the parent to improve the way it manages risk to its broader group operations. And risk to me means anything that might happen or might not happen that impairs the ability of the parent group to achieve its own objectives. So captives are about enabling the group to achieve their own strategic aims. The ways that they can do that: they can improve the group's control over the management and financing of risk. And we heard a lot earlier today about different ways in which captives might be structured to do that. They can be used to enhance the coverage that the parent group achieves for the risks that it faces, whether by accessing additional capacity from reinsurance markets, for example, or by using the captive's own financial strength to fill gaps in the cover available from the commercial market. I've addressed the capacity issue there, access to reinsurance. Another point is compliance. Captives provide a legal, formal structure in which you can recognize and finance your retained risk. So rather than pushing some money aside into a balance sheet fund, you're formally paying an arm's length rated premium to a regulated licensed insurance entity, which in return is giving you a contract of insurance, a contractual commitment to meet claims in well-defined terms. As long as you structure all that properly, and we'll come back later to how you go about ensuring that you've structured it properly, it's a far more compliant structure than a balance sheet fund. You can use it to manage the cost of the program. We talked earlier about how much premium do you need in order to justify the cost of the captive, and it's a straight cost-benefit analysis. Is it going to cost more to set up and operate the captive than you're going to save as a result of operating the captive. That's what the feasibility study analyses and tells you. We'll come back to that later as well. And we talked quite a bit this morning about the potential opportunity to use the captive's insurance license to support the parent group operations. And I can't emphasize enough, third-party risk, actually using your captive license to assume premium from unrelated entities in the hope of making profit out of insurance is a very bad idea and not allowed under the regulations of Labuan or Singapore or the vast majority of domiciles nowadays. Used to be allowed, not anymore. Using your captive to support the core business of the parent in terms of supporting it in offering products to the customer base, which are directly linked into the customer base and are structured to be compliant with all of the regulations applying, can be a good idea. Question of reviewing it and analysing it. No questions yet? Okay. So it's about understanding the potential value of a captive in the broader strategic environment in which the parent group operates. And again, a few of these points we addressed through the discussions this morning. Directors, boards of directors, shareholders, stakeholders throughout your parent organisation are increasingly viewing risk as risk, not in terms of insurable classes of risk. So their questions to their insurance and risk managers are increasingly focused on assessing, valuing, defining the risks which the organisation faces, rather than just how much is the property insurance costing this year. So you've got to be able to understand the broader context of risk facing the organisation before you can understand how a captive approach might add the greatest value to that process. We talked a lot about new and emerging risks. I'm not sure that cyber is really a new risk. Cyber is fully emerged. But the insurance market has not yet been able to develop a persuasive answer to the broadest range of cyber risk. So it's emerging in terms of the ability of the market to help you respond to it, but it's fully emerged in terms of exposure to your parent groups. The stakeholders in the company, the board of directors, the C-suite, the shareholders, customers, suppliers, they all want clarity, they all want certainty. And today's session is focused on managing volatility. The opposite of volatility is certainty. That's the Holy Grail. That's what we're trying to move towards. So any steps we can take that improve the certainty, the predictability of outcomes in your risk finance program are positive moves. Can captive enhance your ability to provide certainty to your shareholders? The risk tolerance level of your parent group needs to be defined and understood. It's not necessary for your organisation to transfer every dollar of risk into the market, unless it's the example somebody asked a question this morning about what if we've got no risk-bearing ability within our group, how does a captive work then? And I think Steve answered in terms of you've probably got bigger issues than captive, but that's an organisation that needs to get risk off balance sheet. Most organisations have far more resilience to risk exposure, far more ability to finance retained risk than they might recognise. And it's important to analyse and understand that. The environment in which your groups operate is constantly changing. Most companies are moving forward on a constant basis. The nature and profile of the risk exposures within the group change the regulatory environment in which they operate changes, the insurance world is changing constantly. So whatever strategy you adopt has to address that inherent volatility within the overall environment. So when entering on a captive project, whether it's feasibility or strategic review of existing captive, you must ensure a clear understanding of the group's objectives. Where is the group trying to get to? And how can risk prevent it getting to where it needs to be? And therefore, how can captive support the group in managing and minimizing that risk? So it needs to be linked into the overall risk management and finance needs of the entire group. A key element that captive provides is capture of data for the program. We're talking about a multinational program, a company with a number of joint ventures, range of subsidiaries that may be unconsolidated in terms of control, risk management, insurance programs. The organization centrally will not understand what the aggregate exposure to risk is, how much it's costing to manage and finance that risk, and how they can improve and minimize that cost. With a captive in place centrally as the hub for a strategy across a group of that nature, the captive can collect and collate the data from across the whole organization. Captive's a formal entity, it's audited, it's consolidated back into the parent company, it's providing regular financial reports back to the CFO. It enables you to gain visibility of the risk exposures and the risk finance programs of the entire group. That enables you to ensure that you can make the most efficient use of the risk capacity of your group, as well as the risk capacity of the insurance market. Again, most companies have more retention capacity than they may realize. You need to maximize your ability to retain risk and finance it in-house before you assess the ability and the cost of transferring to outside markets. Again, we talked this morning about how a captive is a long-term strategy. You're forming a formal licensed incorporated insurance subsidiary. It's going to be around for a number of years. You need to ensure that the setup of the captive and the operating environment of the captive is sustainable for the future, but also to ensure that there's flexibility built in. So there was comment about the need to build in an exit strategy. And again, in the feasibility study, you need firstly to address how would we break out of this captive if we needed to do so, and how does that impact on the choice of corporate structure for the captive and location for the captive. So having talked about the objectives and the process to ensure that the captive project will be driven to meeting the overall objectives of the parent group, what are the issues that might derail the project? What are the key concerns that you need to be taking into account? And it's no coincidence that this is actually the longest list of all the issues that can get in the way, and it's pretty much the case that I've run into every one of these at some stage on a project. So the first and maybe foremost is timing. I mean, does anybody have a feel for how long it takes from first deciding that you want to run a feasibility study for a captive to actually activating the captive? What's the general view as to how long that should be? A year? Any more takers? 6 months? Yeah, there's a few experts in the room, so I was going to say 6 months. Can be done more quickly. It can take a year. The biggest element in that, I find, is the decision-making time at parent level. You as risk manager, insurance manager, may decide that, you know, a captive might well work for me here. You call someone like myself or Roshan or myself or Roshan. Not Roshan, me. And I'll do that pre-analysis as to whether, does it look like it'll work? You know what, there's probably not going to achieve your objectives, so let's look at another way of doing things. Or, yeah, I think this will probably work. Let's study it properly. And I'll come on in a minute to the process we follow in what I mean by studying it properly. It takes 6 to 8 weeks to conduct a proper feasibility study. You've then got to report back to your CFO or C-suite or whoever you report into to get their initial take on whether that's something that they're prepared to put forward to the board or not. If you're setting up a captive, you're establishing a subsidiary, a new subsidiary that's an insurance company, and your business is making widgets or whatever it is you do. So to go to the board with a proposal that we want to set up an insurance company is quite almost use a rude phrase then, quite a bold thing to do. So you need to be certain that you're you've covered all issues fully and that you're more than likely to get the support of the board. All of this takes a great deal of time. Even then when we get the order, yes, we want to go ahead, please start the process to incorporate the company and apply for a license. That's usually, depending on where you're doing it, is usually a 2 to 3 month process. Where's Farah? Oh, she's not here, okay. Even in Labuan, it's probably a 2 to 3 month process. Farah will tell you that she can do it in a day, but that's Farah. So, you know, Labuan is relatively quick. But it takes time. And one of the biggest issues we have is that we in the captive side of the world get called into projects very often when the client or the broker is facing problems completing a renewal, and it's usually a matter of weeks or even days before renewal that they bring us in. So we've got zero chance of solving the problem at that renewal date. So then your question is that problem going to still exist at next renewal? So do we push forward with the project with the 6 months or so to get captive in place ready for next renewal? Or is are we going to miss the bus? Is we don't solve it this year, next year it's not going to exist. So the original purpose of the captive is not there anymore. So timing is a key issue that we need to be aware of when we're going into a captive project. What's the problem you're looking to solve? Is it a short-term tactical issue that doesn't require the long-term strategic value that a captive brings? Or is it something that is part of a broader problem that captive can help you solve in the long term and that justifies the time, cost, and pain of going through the whole approval process and establishing the captive? Another issue is the corporate structure. I've more than once had cases where clients have wanted to set up captives to solve issues within a broader group of companies. And we've got to be aware that a license for a captive is issued, a captive license is issued because you're only insuring the related risks of a group of companies. There has to be a clearly defined relationship between the ownership of the captive and the ownership of the entities that you're looking to insure. And JVs and associated companies may not meet that test. So again, more than once, I've gone a long way down the road before it's become evident that there are companies in here and risks in here that won't qualify as related for captive purposes. So ensure that you clearly understand your corporate structure and that captive is actually appropriate for the range of exposures that you're looking to address. That's related to the issue around stakeholders. I'm not talking about shareholders, talking about everybody who's got some interest in the risk program of the parent group. Internally, that includes all of your corporate departments, legal, tax, HR maybe. If you're talking about EB programs, HR definitely, compliance, etc. You need to ensure you've got buy-in from every one of those divisions before you get too far down the path of looking at captive. You don't want to be in a position of presenting a lovely detailed Willis Towers Watson feasibility study that determines that you should be setting up a captive in Labuan and putting it in place for the following reasons and getting it up and running within 2 to 3 months, and have that be the first time legal or compliance or audit or internal audit or HR have seen that document or heard of the project. You want to get buy-in as early as possible in the process from all of those people who will be affected by it. When we're talking, there are niceties around that. I mean, there are relationship issues. There are some people that you may not want to deal with. There are some who may be likely to be opposed that you'd rather not deal with. But it's better to address those issues as early as possible. Externally, you've got to be aware of the interests of everybody with which the group engages. Customers, suppliers maybe, regulators, the taxman. Again, you don't go running to everybody and tell them we're going to form a captive, but just make sure you're aware of how they may be affected by the captive project, and that if it looks necessary or if it looks possible that they would be a blocker to the project, address that early. Don't get too far down the piece before you address those points. Regulatory considerations, that applies at the parent group level. So if you're a Malaysia conglomerate with a multinational program or multinational exposures, you have to concern yourself with regulatory environment in Malaysia, but also in every country where you do business. We talked earlier today about fronting requirements, a little bit about whether a rating is a benefit or not. You need to address those issues early in the piece. Don't assume that your captive can just issue policies of insurance to your group, or even that your captive can issue a single policy on a group-wide basis to cover all multinational exposures. That's quite a common thing. A group master policy issued by captive to group parent is quite a common approach. That can cause regulatory issues, that can cause tax issues in local countries where the cover is effective. It can cause difficulties in getting claim payments to the local operations following losses. So you need to be aware of all of the regulations and how they play, as well as the regulations in the domicile where you want to set up the captive. So if you're setting up in Labuan, you have to comply with Labuan regulation, as well as parent, as well as local operation for the insurance program. So that factors into the location choice. That factors into where you're going to set up your captive. That also leads into your capital and surplus requirements. Now, there's a wide range of domiciles available for establishing captives. Obviously, here we're talking primarily about Labuan, and if Farah was in here and she heard me talk about anywhere else, then I'd be straight out of the door, without the door opening first. But there is a wide range of choice available, and the regulations applying to the amount of capital that you need to invest to support your captive program vary infinitely from one place to another. So understanding how those regulations will apply to your proposed program is vital, and the surplus that they will require you to maintain, the solvency margin that you'll be required to maintain. Now, there's also issues around, for example, in Singapore, you can loan back the capital to the parent currently, under current regulation. There's no restriction on the ability to lend money to the parent group. So that reduces or minimizes the cost of capital that would otherwise apply. So it's important to understand what is the opportunity cost to the parent group of the capital that you're required to invest in the captive, and then what room for maneuver have you got, what flexibility have you got that would allow you to minimize that cost. Fronting requirements, I already mentioned. Factor to bring into play there is the possibility of a rating. Return on investment, ROI, that's often applied as a measure of success of a captive because it's an operating subsidiary, it's an operating company. So your CFO is looking for a certain return on the investment made in any of his operations, and that will apply equally to a captive. Of course, the key with captive, if you've established it to assist you in minimizing the cost of risk to the group and the cost of risk transfer to the group, then the real value of the captive is represented by that saving. That saving may not reflect in the actual earnings of the captive. So the return on investment that you see from the captive's profit against the capital might not show you the full value of the captive. So agreeing with your CFO, with your parent, what is an appropriate measure of success for the captive program as part of the study process, whether that's your feasibility study or your strategic review, it is important. Tax, you need to make sure that you're compliant with all of the tax regulations applying. I'd love to ask who the people were who thought that captives only exist to evade tax, which was the question put up this morning. Because I'm pretty sure that's a criminal offence, evading tax. I'd have to ask Donald Trump, but the fact is that captives may offer some tax benefits, but if you only go into a captive project to avoid tax, if that's your driving purpose, then that is an offence. Your objective for the captive, the reason for establishment of the captive has to be a true business reason. There has to be a business driver behind the project. It can't be about tax. If you can then, within that structure, legitimately reduce the tax applicable, that's okay, but it has to be legitimate and it should never be a driver of the program. And then we talked earlier about exit strategy, about the importance when you're going into the project of knowing how you might get out of it. That has to be addressed in the study. I'll be quite honest, until pretty recently, I never used to do that. It was never in my studies. It was not, I don't think it was in the majority of studies. We started putting that in now, we now review that for clients. There are quite a few captives that are sitting around the world that are dormant, where the captive was set up without a clear understanding of how they would actually get out of that captive when it ran through its useful life. And when the captive runs to the end of its useful life, the parent company don't quite know what to do, so they leave it sitting there. So of those, I think Andre said about 7,000 captives in the world. There's a fair few of those that aren't doing anything. There's also a fair few of those that I don't think really exist. I've never believed that 7,000 number. I think there's a bit of double counting going on out there. But anyway, the point is to understand how we would break out of this. Now, I've gone through all of that without even mentioning the OECD issues, the OECD BEPS issues, and I'm not sure how familiar anybody in the room is with that. If you're a captive owner or you're fairly advanced in the process of understanding, of reviewing setting up a captive, then it's vital that you fully understand BEPS. If you're at the stage of just thinking about it and you're not quite ready to go down that path, it's probably, I was going to say bore you to death, but I'm doing that already. It's probably a bit premature to look at it in too much detail. It's very detailed. So with all of that as background, you then take your recommendations to the board. You need board approval to set up a subsidiary, to set up an insurance company. You need to be able to clearly define what the strategic objective is and how that is of value to the parent group. You need to be able to clearly explain that you're not proposing to go into insurance. Always, when we come to presenting to boards, some member of the board will say, why are you suggesting we become an insurance company? So you need to be ready with an answer to that. It's not about commercial insurance. It's not about trying to make money out of attracting premium from third parties. It's about better managing the risks of the group and better applying the retention capacity of the group to the risk profile. You need to acknowledge all of the risks and considerations. If you went through them in the same way that I just did, you'll probably scare the board away. So it's more about ensuring that you've addressed these points and that you're ready to address any queries that the board has in relation to them. They'll need a clear roadmap as to the decision-making process and the steps that are involved for them. And you will need, of course, to be able to demonstrate on an objective basis what the cost against benefit scenario is. Now, you're only going to the board for approval if you've determined that the benefit outweighs the cost. But you need to be ready to be challenged on that and to address the process that you followed in arriving at that conclusion. So the process of conducting a review, a study, as I say, this is either for a new feasibility study or for a strategic review of an existing captive. It needs to be a clear and objective process and to follow clearly defined steps so that you have the evidence to demonstrate to the board that you've considered all issues related to the captive possibilities. So we have to define the risks that we're addressing. Again, this is about the parent group risk profile. What is the risk environment, the risk universe in which the parent is operating? What's the group's capacity to retain risk? How much insurance, at what level does it need to start transferring risk to other parties, to the insurance industry? How do we go about optimizing the way in which we access traditional insurance market and optimize the process and the cost base for financing the retained risk? And finally, we have to address the issues for operation of the captive, the operational issues for a captive. So these are just examples of slides from specific exercises that we've conducted. As I said earlier, to me, the risks to a group are anything which may impair their ability to achieve their objectives. If something happens, natural catastrophe impacting on supply chain, for example, or if something doesn't happen, failure to obtain a license for a new product, for example. And this chart just summarizes the risk register that a group might develop. And you're probably familiar with this process. The GRS, the group risk score, is a combination of the frequency, expected frequency of loss in a given scenario set against the severity, the expected severity. So we prioritize the risks that need to be addressed, and this particular profile covers business risks as well as insurable hazard risks, but you can also focus this in on purely on hazard risk. Assessing the risk tolerance of the group, the risk-bearing capacity of the group. Again, you shouldn't be paying to transfer risk to other parties if you're strong enough to retain that risk. But equally, you shouldn't retain more risk than the group can actually afford. And there are various ways to measure this, and each group will have its own sensitivity to different financial metrics. So we would work through with you the group's ability to meet its objectives and its sensitivity to each of these metrics. And what we're trying to do is work out at what level of aggregate retained risk, and this is for insurable risk, at what level of aggregate retained risk within a financial period would that loss impact on the group's ability to meet its objectives. So in this example, we're looking at somewhere between 35 to 50 million in a year, pre-tax, based on the assumption of sensitivity to being impacted by loss. So that gives us a picture of the overall group profile. We then need to assess the comprehensive cost of risk, or the total cost of risk to the group. And that comprises the premium that you're spending to transfer risk into the market and the cost of retained losses. But it also, or the expected cost of retained losses. But it also picks up the exposure that you have to volatility in that retained loss number. So on the left there, the no insurance column, it's obviously the cheapest premium option, just not to buy insurance. But you're now assuming all of your retained losses, all of your losses will be retained, and you're assuming all of the volatility. So if you have a particularly bad loss, you're retaining that entire loss. So taking into account the volatility, that is, in this example, the most costly option. So we're then modelling from the current structure at a given level of retention, the cost effectiveness of each of the options, taking into account the volatility on retained loss. That allows us to set the level of retention that the group should be operating within. Then we need to assess what value captive may add to that process. So in this example, which is based on an existing captive with a single program, so we're modelling the individual program, but where we're looking at multiple programs, we would model each program separately, but then also assess the impact on the probability of retained loss of spreading the exposure across different lines. So this indicates that moving the captive from a current $500,000 per claim deductible to $1 million per claim deductible would be the most cost-effective option, again with the fully self-insured option as a control. So that's the bit heavy on the theory, but that's the process that we believe you need to follow in order to demonstrate to the board that your risk exposure has been identified, that your ability to retain risk at group level, and remember, a captive consolidates with the group. When you insure with a captive, you're not taking the risk off the group balance sheet unless the captive buys reinsurance. That's the key difference from buying commercial insurance where it's winner takes all. You've paid a guaranteed cost premium to the insurer. He will now pay your losses up to the limits of the policy. Well, if you're lucky, he will. Depends who your insurer is. With a captive, you're paying premium into an insurance company. If you have losses, you can reclaim them from the insurance company under the policy, but that insurance company is consolidated back into your parent group. So you've not taken risk off balance sheet by putting it with captive. So moving on to operational issues. The key issues to consider. The parent needs to control the subsidiary. They've set up an insurance company to support their group operations, and that insurance company is there to minimize their cost of risk. They want to control that insurance company. But in order to demonstrate that the insurance company is operating at arm's length, they need to be able to show independence of the direction of the insurance company. So when we set up a captive, we need to establish the board of directors of the captive, and that will include directors from the shareholders, appointed by the shareholders, directors from the parent company. But it must also include directors within the domicile of the captive itself, who are able to exercise sufficient control over the affairs of the company to demonstrate that its mind and management is truly in its domicile, then it's not being operated by remote control from the parent location. The danger of being found to be doing that is that you can be found to be effectively operating an unlicensed insurance company from your home territory. So it's vital to ensure that the control processes allow you to demonstrate that the company is truly located and controlled in the domicile where you established it. Equally, you have to be able to ensure that you are able to meet the regulatory requirements in the domicile, both in terms of the substance of the operation and the ability to make arm's length decisions. Now, I will drop into a bit of BEPS, OECD BEPS at this point. There are three key issues to address here. BEPS stands for base erosion and profit shifting. And it relates to situations where a company establishes a subsidiary in a low tax environment in order that it can shift profit from high tax environments to that low tax environment. So any situation where a group sets up a subsidiary in a lower tax environment and begins to recognize income, begins to make payments from the home environment to the low tax environment, and enjoys a lower rate of tax in that domicile, raises a red flag under BEPS. The way to ensure that you can address any issues that arise from that are to be able to demonstrate that this new subsidiary was formed for strong business reasons and that there's a clear economic rationale behind the establishment of that company. That's where all the analysis comes into play. Within that analysis, whilst we did talk about pre-tax and post-tax figures, there's no discussion of tax. The feasibility analysis, the study is based on the economic rationale of the proposed captive approach as a business case. It's not about if we move $100 million from here to there and we're taxed at 25% there and 5% there, then we charge 20%, so let's do that. That used to go on a few years ago, but not anymore. So under BEPS, you need to demonstrate the economic rationale behind the money flows in the captive project. And that objective analysis is vital to that. It's also vital to have a clear business plan in place to demonstrate what the purpose of your captive is and how it's been structured and how it operates to achieve its purpose. You also need to have substance in the domicile. Now, this is a bit of a painful one for me as a captive manager because what we offer is outsourced management services to captive clients. So when I'm setting up a captive in Singapore, for example, for an Australian parent, and they don't have any operations in Singapore, well, don't worry, because I'll be your Singapore operation. I have a team of people, we're all experts in insurance management, we'll provide all your services for you. So the parent group has outsourced all of the servicing of that operation to the management company. Does that represent a substantial operation? OECD thinks not, if the offshore subsidiary, the captive, is benefiting from a special tax rate, a beneficial tax rate. If the captive wants to benefit from a beneficial rate, it has to demonstrate that it truly has substance in the domicile. Now, we've been through quite a bit of pain in Labuan trying to understand exactly how the substance requirements will apply. I was hoping Annie could explain that for us, but no. Good. The basic rule OECD is operating to is that substance means that the overseas operation has at least 4 full-time employees who are full-time employees of the captive in this case, who are resident in the location and spend their time managing that company. That's where they start from. Each captive domicile is in the process of interpreting that and coming out with their own definitions. There's actually a huge amount of reluctance on the part of domiciles to be too clear, too prescriptive about how they're defining that. Because if they put in clearly in writing, actually you could give somebody in KL an employment contract for the Labuan captive, but they can stay in KL but go once a year for a board meeting and they only need to spend 10% of their time on the captive, that's not going to pass muster with OECD. But if they say every captive must employ 4 full-time staff, base them in Labuan, and they must do nothing but manage the captive, that's not going to pass muster with the clients, because the cost and practicality of that is not going to work. So there's a sort of game going on at the moment of trying to define what substance really means. And we don't have, unless Annie tells me differently, we don't have a very clear answer for Labuan. We were notified by the MAS in Singapore in mid-July that we should interpret their requirement as meaning that we should have at least 50% of the time of a full-time employee dedicated to captive, but it's up to us to explain how we're going to do that. That's if you want to take advantage of the 10% rate that you can apply for in Singapore. If you just want to run a captive and pay full local tax in Singapore or in Labuan, you don't have to comply with those requirements because you're not enjoying a special rate of tax. So clearly you've not set this up to avoid tax. So there's a lot of, I've said about how avoiding uncertainty, captives are all about giving certainty, avoiding volatility, etc. This is an area where they're introducing some uncertainty. The third element that we need to address is transfer pricing. There has to be evidence of an objective process in the setting of premium. Now, again, that's where all those charts and analysis come into play. Because what we're doing in that process is valuing the risk. Applying probability to exposure to define how much you need to set aside against a given exposure to risk. That forms the basis for premium. That's how all the insurance company guys in the room go about pricing their risk. Except that you then knock 50% off because the guy down the road is offering it for 60%, but leave that to one side. So there's got to be clear evidence of how you've gone about setting your premium on an objective basis. You can evidence that by saying, actually, Mr. Insurance Company is offering the same policy at about that same price. So that's evidence that that's the market price. Vengor and Andre this morning mentioned the premium rating service from Swiss Re, if they're providing the reinsurance. Again, that's evidence of the fact that they've set the price. We didn't make the price up in order to be able to move a chunk of money across to the captive for whatever purpose, tax saving or whatever. That's the price that has to be charged. So you have to be able to evidence how you've arrived at your premium in order to justify it as a business expense for the parent. And there is a tax element to that because unless you can justify that it's an arm's length objective price, market price, you will face challenges in deducting that premium from taxable income at the operating company paying the premium. So that, quite early, is the background, the theory, the process. It's about demonstrating the objectivity of the process. So looking at some case studies, we gave in the panel session this morning some examples of where captive has added value. I'm trying to see which example this is. Yeah, this is very similar in concept to the example that Christian gave this morning. So a large integrated company, they suffered a major loss. It really triggered them to stand back and look again at the way in which they were approaching risk, the way in which they were approaching the whole definition of exposure and management of retained risk. So we went through the whole process that we've outlined, but on a portfolio basis. We didn't just look at property risk or liability, we looked at the whole range of risks that the group faced. And the outcome of the project was clearly defined retention capacity for the group for the first time. They hadn't really understood this previously. Prioritization of the risk exposures. And then combining those risks into the multi-line structure that, again, earlier today, Veng showed in the diagram. I'm really missing having a whiteboard because I'm doing lots of sort of hand moving. So anyway, if you can remember Veng's diagram this morning with the multi-line structure and then the excess towers, that's what we did. So the captive provides that strategic enabling role. It's there as a hub for the consolidated program, and it's there to minimize the cost of risk, maximize the flexibility. So that was an example of one that went right. Let's talk about one that went wrong. This project involved, it's an Asia-based global conglomerate. It's a project that I was heavily involved in, so I'm not gonna absolve myself from blame for it going wrong, except to say it wasn't my fault. It was a huge group, and it had grown dramatically in recent years, largely by acquisition. So they had a number of different moving parts within the group, a lot of different decision makers. They hadn't really pulled a number of these companies into the sort of culture of the overall group. They operated independently. And they hadn't consolidated the insurance and risk programs. So a newly appointed insurance manager at head office decided that he would be a hero by taking them in one step from that situation to the level of global, sophisticated, centrally controlled risk and insurance program, all centered around captive as hub, as strategic enabler. Exactly what we'd done for that other company. They actually had a few captives within the group already that they'd acquired when they bought other companies, and that were largely sitting around dormant or were writing very tiny little areas of the program. To get his CFO on board with this process, with this project, the insurance manager made commitments around the savings that would be achieved. And he made pretty aggressive commitments. And he then tendered for a consultant to deliver this. And for our sins, we won it. First issue we faced, somebody this morning mentioned the problem of getting data from groups like this. I can't remember who he was, somebody mentioned the problem, I think maybe in Roshan. That was our problem number one. We spent the fee just trying to help them collect data on their programs. Massive problem. They didn't have any access to data, any control of data. Various subsidiaries just refused to share the data. So huge problem. The next problem was the lack of buy-in from the operating companies. A, they didn't want to share data. B, they didn't want to change their arrangements. They had local relationships in the market and with consultants and brokers. So fairly early it became clear that the project wasn't going to achieve the levels of savings that he'd committed to. They were always pretty aggressive. And in hindsight, we should have gone back and kicked back on that, but it was part of the process of winning the deal. So we ended up spending months on the project, failing to deliver the targeted savings that he promised to his boss, making him look bad, and failing to get beyond that initial stage. So it's all those lessons around ensuring that you've got buy-in from senior management, at least C-suite, preferably board representation, because you're going to be going to the board at some point. Ensuring that the stakeholders are at least not opposed to the concept that you're working with. Being realistic about that concept. And again, we discussed this morning how occasionally we do start a captive project with the objective of that big bang of creating the captive as a hub for all risk and running a consolidated program. More often than not, we're starting captive with a single line, a single risk. It's more practical, it's more easily achievable. So a number of lessons out of that one. I have got, just to finish with, it still says case 2, which should say case 3. Another successful one, so they don't always fail. And this is a large group. This is a captive strategic review rather than a feasibility study. But this is a captive that had been in place for a number of years, had been set up on a perfectly logical, viable basis with proper analysis sort of 7 or 8 years ago, but they hadn't updated the analysis. And they were moving into a major expansion phase in the business at a time when they had concerns about some volatility in the core business, actually about oil prices. So when we reviewed the work they'd done previously on risk tolerance, it became clear that their risk-bearing capacity was actually much lower than they thought it was. So that had not been kept updated. They hadn't adjusted the strategy to address the group's reality at any given time. They were taking reasonably big shares of excess layers that they'd begun to assume in years prior for tactical reasons and then not adjusted going forward. So they had really quite significant dollar exposures. Because it was in high excess layers, they were taking the view that the probability of loss was tiny, so they didn't need to worry about it. Well, you don't need to worry about a $1 billion loss until you have a $1 billion loss, and then you've really got to worry about it. And they did have exposure to $1 billion losses, one in 200 years or whatever, but I mean, they had the exposure. That's not captive business. That type of retention should not be sitting in captives. That's company killer type exposure. You need risk transfer for that. So we adjusted the program. We focused their retained risk and the captive involvement in the primary layers where there's more premium and where the exposure is more to frequency, more to aggregate loss than to severity, and protected that with aggregate reinsurance. So brought the captive to being more focused on their risk tolerance and more supportive of their group objectives.